So in today's Cheeky Trading, I'm gonna be talking about exponential moving averages. What are they and how you can set them up in TradingView. I'm also gonna be talking about how you can use these EMAs to verify trends and to see where the trend might be over. And finally, I'm gonna compare these EMAs in low volatility markets and high volatility markets. So if you're curious about this, just chill and keep watching. Hello everyone, how's it going? Welcome back to my channel, and this is your host, the Cheeky Entrepreneur. So today I want to talk about a very important indicator, which is the exponential moving averages. And you might have heard of normal moving averages. So first of all, a moving average is just basically an indicator which grabs a set number of points that you tell it. For instance, it could be 20, 50 points or 100 points or of the price, and it just creates an average and creates a single point, which is gonna be basically that line. So as opposed to the simple moving average, the exponential moving average is a weighted moving average. And what this means is that it gives weighting or more importance to recent price data than the simple moving averages. And what this means is that this exponential moving average reacts quicker than the simple moving average to recent price action. And you can do your own research to know the exact formula for the moving average, but it's basically based on the simple moving average and a multiplier. So the first thing that I want to teach you is how to set them up in TradingView. So the first place where you need to go is, as usual, indicators and strategies, and you're gonna be writing for EMA, and you're gonna be using this one, which is the most liked. I'm gonna teach you how to set it up. So basically the most important moving averages or exponential moving averages are the 20, the 50, the 100 and the 200 EMA. So if you want to change this in TradingView, you're just gonna go to the cog over here and you're gonna change the length to 20, 50, 100 and 200. So there's different styles for these EMAs, but what you usually will find out is that the shorter EMA, the 20 EMA, is gonna be a little bit of a pink color, then the 50 is gonna be kind of a green color, and the 100 is gonna be more of a yellow color, and the 200 is gonna be more of a red color. So this is the basic setup for the 4 EMAs. So the first thing to notice, and it's very important to highlight, is that the moving average or the exponential moving averages, depending on their length, are gonna dictate which time frame they use. For instance, the lower moving averages move faster within a short time frames, where the higher, like the 200, are moving within a longer time frame. And this is very important because of the price fluctuations. The longer the time frame, the more resilient and the more accurate your line is gonna be, because it's gonna take more samples and it's gonna reduce the noise. So here I want to establish the difference between the exponential moving averages and the simple moving averages. So here we have the exponential moving average, as you can see, and if we bring the moving average, you're gonna see that the price is kind of slower in terms of this big drop, so it's reacting slower. And this is very important because mostly you're gonna use the moving averages for investment, because basically all the data is weighted the same, meaning that it's gonna reduce the noise over time. But if you are trading, you are most likely gonna be using the exponential moving averages, because you're most interested in what the current price action is doing and how you can actually profit from that volatility. So these indicators are very important to figure out and verify trends and to know where the trend might be over. And just in basic principles, the derivative of that line is gonna be the slope, which is gonna indicate if the trend is going down or if the trend is going up. So as you can see, with the price action, the line of course is moving down when the price is moving down, and when that price is actually turning, you will find out that there is certain crosses. So these crosses are very important because they might indicate you that the trend is over. So for instance, around here in this area, when the price is actually going up, or down in this scenario, we see that the price bounces from these lines. So for instance, if we take a closer look at this area over here, we see that whenever we have this 200 EMA around here, we have seen several bounces around here and the price started moving downward. Then we saw another couple bounces around here. We saw kind of what is a fake out to the upside, but the trend actually continued going down. And this is very important because this is a way to verify where the trend is, because you can see that most of the EMAs are pointing at a certain direction. So the EMAs are not only good to signal or verify where the trend is going, they're also very good to see where the trend might actually be over. So for instance, we have in this scenario the 200 moving average moving downwards, but we start seeing that there is been some crosses in the lower time frames, in the lower EMAs. So here we can see that, for instance, the 50 EMA and the 20 EMA are actually crossing around here, and this is very important because they're the first indicators that the price might actually move up, but we still have the stronger time frame going down. So now if we continue moving, we see that these lines are actually starting to cross the 100 EMA, which is a more important line in the longer time frame. So at this point, you might be starting to suspect that the price might continue going up. And what happens is that it continues going up and we actually break this 200 EMA. So whenever the price breaks the EMAs, it's not a real indicator that the price is actually going to start moving up. You still have to wait for some confirmation. In this scenario where the price actually bounced back down, we actually see that it's sustained by the EMAs. You know, whenever they cross, here we see that the 100 EMA is actually sustaining the price and it's not letting it go down. So in addition to this, you can see that the 50 EMA and the 200 EMA are about to cross at this point. So you would be likely to take a long position in here with a defined stop loss. And what we see is that the price actually goes up, goes back down and retests this line. But something very important here is that we have actually crossed the 200 EMA with the 50 EMA. And something that I've learned from experience and from books that I've read is that the most important lines, or at least in my opinion from what I've read, are the 200 and the 50 moving average, because you have a very long term and you have a medium term kind of indicator. So here in this spot, for instance in the pound dollar, we saw that the price of these two lines was actually crossing, and this is again a very good indicator or a way to verify that the price might actually go up. So if you take the signals from these EMAs before, you see that they're crossing, and then you see that the price is actually not able to move back down and that there is support from, for instance here in the 100 EMA, you would be likely to go up or to take a long position. And if we take a look at what happens next, we see that the price actually move forward. And again, in an uptrend, you will see that these lines are gonna be a resistance for the price dropping down. And we can see over here where the 100 EMA has acted as support for this price. Then we move up, the 50 EMA has acted as support for this price. That again in here has acted as support for this price. And it's very important to know that the higher time frames are gonna be more important resistance points than the lower time frames. And just as we commented before, we see in here that the lines start crossing down. Here you might have the opportunity to actually say maybe the trend line is over. And again, some confirmation in this is when this 50 and 200 EMA crosses, for instance around here, you could still have waited for a bounce in here and go even lower with the price and profiting from there. So to end this video, I would like to compare different markets, and for instance we have more volatile markets, for instance gold, we have cryptocurrencies, and we have less volatile markets just as stocks and also forex in a sense. So I would like to compare how the EMAs behave, because it's very important to know the market that you're in. So if we look, for instance, at the Dow Jones Industrial Average and we put the 4 EMAs, we can see and we can verify the trends going on the daily chart, and it's pretty easy for the eye to see this. And for instance, here we see that there is some resistance coming from these lines. And as I mentioned, the most important lines, for instance, are the 200 EMA and the 50 EMA. And here we see several times that the 200 EMA provides support for the price. So this is actually a good opportunity to actually buy and continue the trend. And in lower time frames, we also see this happening. For instance, here in the lower 50 EMA, we also see some support, and then after the support, the price continues moving up. And if we continue, again, we're gonna start looking at the price having support in the longer time frames. So this really depends on what your strategy is, because if you are more of a scalper, you might want to use more the 20 moving average or the 50 moving average. For instance, if you're scalping, you might actually try to short the pricing here and try to get maybe some movement in there, or maybe bounces from the 50 or the 20 EMA. But as I mentioned, the higher time frame, the higher the moving average, the more support you are gonna find. And for instance, we have seen that even that the Dow Jones have gone down, in here you have found tremendous support from the 200 EMA. And even in this scenario where the price is still bouncing up from these levels. Now, of course, as I mentioned you before, whenever the EMAs are starting to cross down and you're starting to see support from them, and avoiding the price to actually go to the upside, then there might be the opportunity for a trend to actually finish. And here we have seen that the price has broken the 200 EMA. So it wouldn't be out of the question to actually see the price of this starting going down, and it might be good to have to hedge this price or to actually take a short. So now let's move to a little bit more volatile markets. So for instance, if we go to gold, and the reason that I'm comparing these markets is because you're gonna be less reliable with these EMAs. And again, you're not gonna only use these EMAs, you want to put it in conjunction with other indicators and with other knowledge in order to be more resilient. And here I'm bringing gold because it's very volatile, and you can see that even though that we have all these prices going up, and the same, we follow the pattern of the EMAs, these prices move quicker than low volatility like forex or the stock market. And whenever you have this, it's more difficult to actually use the moving average or the exponential moving averages, because you have to anticipate. For instance, here we have a cross of the 50 EMA and the 200 EMA around here, but the price is actually way up. So if you were to actually long at this position, you would be risking a lot, because the price has already gone up. The price is way quicker than these indicators for very volatile markets. And because of this, you have a lot of consolidation phases where the price actually goes up and breaks down and breaks up again, for instance in this scenario, and this is not very reliable. These are not very reliable signals. And that there is less reliability on this, it doesn't mean that they don't hold any significance. I mean, you can still see how the price, for instance here, is bouncing from the 200 EMA, and when it actually breaks down, it's actually grabbing this line as a resistance and actually go down. And for instance here in the 20 EMA, you can see that it bounced from that line and it goes actually down, and it's basically another resistance point. But it's important that you see that the more volatile the market is, the less significance these lines might have. In any case, guys, I hope that you enjoyed the video, and if you did, and only if you did, mind subscribing and also like the video. You know that I'm active in other social media. I got an Instagram account and a Facebook page where I post more about entrepreneurship and put all the highlights of my videos. But in any case, just before I go, I would like to remind you as usual: stay smart, stay bold, but most important of all, stay cheeky. Take care.